Before the auditor is ready to render their opinion, they must conduct some final procedures to ensure that they have sufficient appropriate audit evidence to form an opinion. These final analysis procedures allow the auditor to take one final look at all the evidence. The first thing they need to do is aggregate all of their findings. So they need to look at the working papers, they need to look at the reconciliations. If it's a larger company, they might need to test consolidations. They will need to review the policies and disclosures. So they'll evaluate the overall reasonableness of the financial statements. This is an important step to look at all the evidence in total that the client has. Because we've been so focused on individual accounts, it's often possible to lose track of the forest for the trees. We'll need to collect some legal letters. These are where we ask management to reach out to the lawyers to ask them, what are the outstanding legal claims? Contingent liabilities can have an important impact on the financial statements, and management may not be inclined to disclose them all. The lawyers represent a unique information source. However, management must send a letter requesting the correspondence be sent directly back to the auditors. Now, we will not be responding to the general counsel, who is an employee of the corporation. We're specifically looking at outside legal letters on any outstanding litigation that represent the client. So we'll also request management to write us a letter. This is an important and if not critical document which management orally documents all the oral statements they've made. This will include statements regarding the amount of evidence they have, etc. They'll also try and clarify any issues and accept responsibility. You'll want that signed by the CEO and CFO on the date we're done completing field work. The reason why the dating is really important is any statements made after that would not be contained in the management letter, so we date this at the last possible moment. So other specific things we would want this letter to contain is that all records and data have been made available. And so that management is accepting complete responsibility for the internal controls, that they've told us about any significant deficiencies they're aware of, and any information on fraud. And so this is our one-step coverall. Essentially, it's our insurance policy that if a problem does come out later on, we can always say, management did not tell us about it. So we put a lot of pressure on management to be as forthcoming as possible in this letter. This should not be any new information. This should be a summary of old information that we have collected throughout the audit. The auditor may actually help management identify those critical statements that were made during the audit that we would like documented. We'll also look at the information that's accompanying the financial statements. This could be an annual report. This could be any number of things. So we'll either issue a positive opinion on that with a high level of assurance, or we won't say anything at all. We'll disclaim an opinion, but we'll have to clarify that in our audit report. So that'll be an issue we'll address in this final stage. We'll also ask some critical questions. Do we have enough evidence? So as we look through the evidence, we're going to ask, do we have enough? If we don't, we're going to have to accept that we're going to have to issue qualifying opinion or disclaim an opinion in an extreme case. Do the individual immaterial errors add up? So not thinking about any one error, but if we have several small errors, we may have to work with management on how we need to revise those, or let them know we're going to qualify the audit opinion or even give an adverse. And if it looks like this process is not going well, we may even consider resigning. We'll also review our documentation as a whole. The reason why we're doing this is threefold. One, it allows us to evaluate personnel to see who is doing their job within the audit firm. We're not ever evaluating the client personnel. We'll also ensure that audit standards are satisfied. We've discussed before, there are specific standards which govern how documentation is to be done. This is an important way we do that. We also counteract any bias in auditor's judgment. Sometimes you get so laser focused on individual issues, of bias emerges, and this will hopefully address that. We'll also have an independent review partner go over everything that may identify notes or additional matters that need attention. We'll also have an opportunity for a sober second thoughts. And so now that we're not in the middle of the audit, is there anything that still gives us pause? Now that we've moved past some of the narrow issues, what are the big issues that we are still concerned with? Throughout the audit, we may have actually found errors. In this final stage, we're going to want those corrected. So this may be, they're called adjusting error entries. The auditor will recommend them. Management will make them. And so the auditor will never make accounting entries for the client because that would be us engaging in accounting, which violates independence. So we may have material adjusting entries that are just individually immaterial but combined represent a material. We may have an adjusting entry which we think, well, not number-wise may not be that significant. From a qualitative perspective, it may not. We may list through some of them that we think are non-negotiable. We need all of these made, and those are required to get a clean audit opinion. And other ones we may just think are best. Some of them may be self-correcting, and so we're just recommending it. We don't start next year with a problem, but it doesn't actually distort the financial statements. Where other ones we think we're going to need to correct, and we do want to consider both the pre and post-tax effect as that it impacts materiality. We'll also need to, at this stage, continue our conversations with audit committees. Many years ago, this would have been done just at the end of the audit, but now frequently the audit committee chair will be in correspondence with the partner throughout the audit. But we are required at the end of the audit to talk about frauds, illegal acts, internal control problems, mediation issues, etc. with them. We'll also may make some recommendations for them on things they could do to enhance their operations that we've seen or controls we'd recommend they implement. We'll also start to evaluate going concern. And so these are things we might see which suggest the company may not be surviving and that we would need special disclosures. If they're laying people off, if they've had negative cash flows from operations, if they've lacked profitability, they have excessive debt, underperforming assets, they can't get more capital. These would all be warning signs. Any one of them may not be problematic, but a series of them or repeated signals over several periods would all indicate that perhaps we have a problem. So what would be some solutions that would lead us to believe that maybe management's got a plan to get out? If they actually talk about further layoffs, that they are delaying expenditures, that they're refinancing, disposing of assets, they've got new marketing, they've got a commitment for more capital. There's a lot of ways you can get out of going concern problems. What we need to do is use our judgment to evaluate whether we think management's plan is reasonable. After we've completed this, we've essentially got all the evidence we're going to get, and we're ready to issue our opinion. And so we'll move on to that in our next video.